Good evening and welcome back to the latest edition of the InvestTalk market analysis for the week ending October 21st, 2022. Appreciate you all tuning in to this channel as well as our podcast InvestTalk, and appreciate you subscribing to both as well. Now this week I'm going to title the video, "The Fed Pause Has Arrived," and it arrived right before the window for the blackout window before the next Fed meeting, which is the week after next. So we're coming up on that one, and we there was a leak through the favorite. I forgot the name of the guy, but one of the reporters at Wall Street Journal that typically talks about kind of leaks the Fed expectations going forward, and they basically said was they're going to do 75 in November, so it's November 2nd, and then they're either going to do a 25 or a 50 basis point hike in December. So here's that 95% chance of 75 and only a 5% chance of 50 basis point hike, and then December. So that would put you 375. So there's now the base case is now a 50 basis point hike in December, and now that's a big increase, right? So from 24% yesterday and up to 51.8% today, and the 75% chance of a 75 basis point hike is now the underdog. So that's a big change in sentiment, and that's a bit of a dovish pivot, or what I call a pause, right? They're basically hitting that, hey, we're very close to the end of this rate hiking cycle, and we're going to pause, see how things go, see how inflation evolves. Remember, monetary policy lags, right? It takes a while for all these these rate hikes to feed into the economy. So those first few rate hikes back in the spring, we're just starting to feel that now, and we're going to look at some of that data. Obviously, the housing market, because it's so rate sensitive, that one's going to be the most reactionary, at least in the near term. So let's look at the economic data that did come out this week. Industrial production came out on Tuesday. That was a tick higher. So I've said this before, onshoring manufacturing, all of that. I think that is going to continue to be a relatively strong part of our economy, although you're going to have some dips like you had over the past few months, but they're all pretty minor, right? Less than 0.1%, and then nicely positive months in between. Now the Wells Fargo Housing Market Index, that closed at the lowest levels since the COVID crisis, and then if you go all the way back, this is the lowest levels pretty much 2013 timeframe. Yeah, so definitely poor out there, but 7%. Let me go here actually, a 7% mortgage rate, and you're still seeing the housing sales hang in there. Now, remember, these are closed sales, so these are probably things that got into escrow these are September, so they probably went in escrow in July and August. So clearly this is going to continue to decelerate, down 23.79% year over year, down 1.46% from last month. So minor deceleration there. And then the housing starts down 8%, but you kind of just vacillating back and forth. Overall, the housing market's weak. You can't really say anything different. But the business, and this is actually probably the weakest point of the data points. And look at this. This is October. Remember, all these other data points are usually September. This is October, negative 15.5. You haven't seen this since February of last year. This is a New York Fed survey. So I think this is a good indication that the Fed is starting to say, hey, maybe we should calm down here. Maybe we should slow our roll and pause. And I think that's exactly what they're doing. So I wanted to highlight that. Also, I want to really highlight this, which is the retail traders put call ratio. And so when this goes up, it means that there's 3 times here, because this goes up to 3, right? 3 times as many puts being bought in the market than calls. that is extreme in the sentiment indicator standpoint. And you can see that the last low in 2016, remember December 2016, when things were really falling off a cliff around Christmas time. And Steve Mnuchin came in and talked to the Fed and all this stuff. And, the market turned around and there was a Fed pivot. And then the last other time was the bottom in 2009. So now, is this the ultimate bottom of this bear market? I think it's certainly a possibility. You have to be open to that. Now, do we have a rally here and it kind of peters out? We'll see. And here's the S&P. Let's pivot over there. Now you can see here, last Wednesday, we had that reversal. We talked about that. We didn't get the follow through on Friday, but we did this Monday, right? We did get a nice little up day and Tuesday, little pullback into Friday. And we were down in the morning on Friday, and we rallied on that kind of Fed leak that they're going to pause very soon. Now, once again, is that going to be enough? Is that going to be enough? Is getting to 4.25, something like that on the Fed funds rate? Is that too high? Can the economy handle that? You're probably going to get mortgage rates come back in. You're going to get some rates to come back in. But the question, are they going to come back in enough to make this likely rally that we're expecting to be out into somewhere into December, maybe into early next year? We shall see, TBD. But how strong that rally is going to be a good indicator of whether the bull market or bear market is over. And then there's some other indicators as well, like the dollar. We'll look at that as well. The dollar, this is another kind of signal to me recently that we weren't going to really break down because the dollar wasn't breaking out again. It kept rallying and then failing, and you saw that reversal today, and you see the MACD, look at the MACD divergence here, continuing to weaken. So if we can get a sizable pullback in the dollar, that will definitely be helpful for markets to quell some of the issues overseas, what's happening in Japan, what's happening in the UK, and they're dealing with higher rates and weak currencies. So they're dealing with inflation that we're exporting basically to them, and it's not helping their overall financial situation with their level of debt. So the dollar certainly being weak is helpful to markets. And that sounds counterintuitive, but it definitely is. Now let's take a look at some ratios here. Here's IWF to IWV. No, not a shock here that if the Fed does go on a pause, you're probably going to get some relief rallies in the growth side of the market. Now, I don't think that's going to be that durable, but it's probably going to take place. This might be a good time if you are overweight, too many tech names, too many growth names, to start to trim into that. I think that's probably something to consider. I can't recommend that, but something I would definitely consider. The reason why I say I don't think it's going to be this next huge bull leg in growth stocks. Look at ARK, right? ARK is showing a bit of strength recently. We'll probably get some similar rally like we got in May to August timeframe. But overall, that was just a modest rally amongst a long bear market. And many of these names within ARK are very poor, unprofitable companies. Now let's look at the VIX. We talked before, a higher trending VIX, you've really seen that since last fall, is a negative for the markets. Now what's interesting here is we made a lower high. Hey, and it's 2 consecutive lower highs. Isn't that interesting? Remember, this was the low in June. Had that good rally. We had the recent sell-off, and now this is coming back down. Now, where does this make a new low? Right? Because this did make a higher low. So you have a series, kind of a wedge here, right? Lower highs, higher lows, and will resolve one way or the other. And something that I'm watching to see what kind of traction that this can get to the downside. Now let's look at the 10-year. They did reverse. Let me pull this up here. This is a monthly chart of the 10-year. Actually, let me go to a quarterly chart. No, that was a weekly. Excuse me. There you go. Quarterly chart. This goes back all the way to 1981. And if you run a fib here from high to low, what do you get? You get 4.3% on the 10-year. And where do we get to today? 4.3%, and we reversed. Shocking, right? Do we get a consolidation period before we break out to higher rates? I think that's probably what we get. Now, is it a larger pullback, or is it just more of a consolidation right around the mid threes to low fours? I think that's certainly possible as well, especially in the inflationary environment that we're likely to see for the foreseeable future. So I do expect rates to kind of at least peak and get choppy for a bit of time. But hey, it could be wrong. Now let's also look at the SHY. You saw this is the short-term rates. This had a nice reversal today, but not that powerful. Not that powerful. So I'm definitely going to see some more strength from there. Now on the currency side, we talked about the dollar, but let's dig into the euro. That's getting some traction, still below the 50-day moving average. This will really get some juice if it gets above that 50-day, and then the 100-day. That's going to be a big resistance. The British pound, obviously Liz Truss, the lettuce won. There's a great live stream started about a week and a half ago about who's going to last longer, a head of lettuce or Liz Truss. Well, the head of lettuce won, and Liz Truss is no longer, will be no longer prime minister once they find a replacement or vote on a replacement. So she lasted basically 44 days as prime minister. The market's liking that so far, that her policies, economic policies, weren't exactly what she wanted or what the bond market wanted. And I think they're optimistic that any new leadership will maybe pivot directions and make their fiscal situation a little more palatable. The yen, that was actually the big move. This is FXY. So this is the yen, powerful move. Look at the volume here on Friday. Just massive reversal. And typically when you get a long move and you get a reversal on high volume, that means it wants to go the other way. And I do expect the yen to get a bit of a rally. And that's all going to feed into gold, right? So here's GDX to the GLD. Starting to find that bottom here. You're getting a nice surge. Getting above that 50-day or 100-day, would be big news. So definitely watching that. Let's look at the pure GDX. That also, right, testing that 50-day. And I want to look at GDXJ to the GDX, so the junior miners. And, that started to break out in July. You have this consolidation period and looking like it's ready to break out once again. And that is a positive for precious metals as well as silver to gold ratio. As long as silver to gold ratio is headed up, that is good. And that started last month and has really been consolidating here and looks ready and poised to make another move. I want to highlight a few sectors that did very well. The energy sector continues. Its relative strength has always been strong. You had a pullback throughout this summer, but still relatively minor considering the strength in the dollar. So you get a little weakness in the dollar. These things are definitely going to take off. And here is DBC. So commodity index, that underlying commodities didn't move a whole lot, but definitely the sectors did. Here's the IYM, the material sector, that had a pretty big reversal. And you can even say here, IYM to the SPY, that ratio, that's breaking out to the upside. So something that I wanted to highlight there, the commodities in general, whether it's energy, whether it's basic materials, all getting a nice pop. And then lastly, I want to get to this, the IAI to the KBE. So this is the investment banks. IAI are the investment banks. The KBE are your traditional commercial banks. And look at that reversal over the past 4 days. And some of this was earnings, right? We go to Morgan Stanley. We look at Goldman Sachs. They reacted pretty well, whereas some of the commercial banks, I guess JP Morgan responded well, but Wells Fargo a little bit. But mainly I want to go back to this, and I want to show you that this ever since the market peaked, this has been in a downtrend, right? So commercial banks, they're riskier businesses. So if you are less optimistic about the economy, they're going to underperform. But now they're starting to outperform. That is an indicator that you want to pay attention to, especially this thrust higher over the past few days. So I wanted to give you a heads up on that, right? Reason why do investment banks struggle when the economy is getting weaker, when liquidity is tighter? Well, how many bond sales are going on right now? How many mergers are going on right now? How many IPOs are going out right now? Very little. That's how investment banks make money. All of those type of activities. Commercial banks, they make money by borrowing short, lending long. It's a very different business and is usually steadier. And so if the commercial banks are underperforming, that means liquidity is getting tighter, that means the economy is getting weaker, et cetera. And now you are getting a shift in that sentiment. So is this an indicator that, hey, liquidity is going to get more abundant because the Fed is pivoting? Maybe the dollar is going to get weaker, and all the things that were now a headwind to the markets are suddenly going to have a tailwind, and you're starting to get some indicators for that. So I wanted to really touch on that to close it up. But I want to thank you all for tuning in, and appreciate you all subscribing to this channel. And a reminder that the contents of this video are for educational purposes only, should not be construed as a recommendation to buy or sell a security or to participate in investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Thank you all and have a wonderful weekend.